The Fed cut rates today, half a point, put an end to the longest cycle of rate hikes in years. What does it mean, though, for regular Americans and their wallets? What kind of moves should you make? Doug Flynn, joins us right now. Flynn Zito Capital Management. We went over Diane Swank was on, went over the whole thing, about quarter point, half point, what's next, and all of that. What should people do? We asked you beforehand, and we have a couple of screens to put up. I want to talk about what just regular consumers, let's put that up first, should do with the Fed rate cut, because borrowers pay less on their debt, savers get less, and you point out the Fed only affects the short term, not the long term. Can I start there at the bottom? What do you mean by that? Why is that important?
Yeah, so first thing is, like, when it's like gas prices from the standpoint, when rates go up or gas prices go up, they happen immediately. But when they go down, they tend to kind of go down a little slowly. So what I mean by that is that, for instance, like, they're going to cut the prime rate, which affects home equity lines of credit and the like, but it doesn't directly affect the mortgage rate. The mortgage rates are tied to the 10-year Treasury, and that didn't move today. So while that will go down, it's not going to go down a half a point. So people's expectations on their mortgage rates, and a lot of that has already been built in. The mortgage rates are down about 1%. So it affects the shorter end. It affects, like, your savings, and it affects other types of debt, like credit card debt and other auto loans. Those will slowly begin to come down. It has an impact there, but not on the longer end of longer term debt.
And as focused as we are on the positive, the second bullet you had on that first screen is about savers getting less. I mean, it's particularly older people that are watching the show today might say to themselves, man, this hasn't been bad the last few years. I haven't had to take much risk, and you get 5%. Because for years and years you were getting nothing on your money. Now what? They don't want to take on more risk at this point in their life. So now what?
No, a lot of people did move money into the money markets that hit 5%, and you're going to see those rates go into the 4% range very soon. And next year, they're going to be in the 3% range. And depending on how much the Fed cuts, you might end up with those money markets back into the 2s eventually. But they're going to go there. So this is the opportunity now to say, if I like some rates in some longer term CDs or even some short term bonds, lock them in.
I'm going to come back to this. Sorry, I'm going to interrupt you for a second. Karine Jean-Pierre is actually talking about inflation. Just a quick listen here at the White House. This is live.
And so, I'm going to let the Fed obviously speak to more specifics about their decision, their monetary decision. But we have seen inflation going down. I think that's important. That's important to the American people. That's important for families, for businesses. And so I think the progress being made at this time is critical. And we have said this was coming. I stated earlier that there was a time where folks were saying that we needed a recession. And this has proven through the president's economic policy and what he's been able to do that we didn't need to do that. Right, we needed to make sure that we.
All right, so a lot of that was what, Doug, we were talking about earlier, where they think they've kind of done what they need to do on inflation. We get it. Now, I guess you shouldn't say it as much, but Jay Powell's worried about jobs a little bit more, and all of that kind of makes sense. You want to get out ahead of it if you're Powell and company, so you try to prevent a recession, right?
And they're taking credit for it, but I thought the Fed was independent of the.
Right. Well, that's true. That's a fair point. That's a fair point. So every side gets in on this, on the political. So we don't try to influence them. Trump says he would. By the way, he says, no, I think I should have a say in this. And then,
that's true.
And then on the other side say no, but then we get the credit. I don't know if it works both ways. Your other suggestion had to do with just people investing, right? So the impact on the markets of the companies. Let's put up that screen, because this is interesting today. You talk about the market valuation being stretched, but opportunities in the bond market, which we were kind of getting to a minute ago, you can lock in your yield. Also, small companies can benefit. I'll try to get to that in a moment. Take the middle one, lock in your yield. Regular people, what do you mean?
Right. So if you go to some short-term bonds right now where you still have a 5% yield, as those rates come down, you're going to get a benefit from some appreciation of the bond prices. Bond prices in general are at their lowest point in the last 40 years. So that means that as rates come down, the prices on those are going to go up. So it does two things. You can lock in that yield in the 5% range, and you could possibly get 1, 2, or even more % in appreciation in those bonds without even going very long out there. But if you stay in the money markets, you're going to go right down with money market rates. So you just have to know that that's going to fluctuate, but that's the opportunity there in the bonds versus stocks right now has priced in all of this. And so they're very highly valued, and the risk return, what happens essentially is that 1 year after the Fed rate cuts in the past, the bond market actually matches the performance of the stock market 1 year out, but with only a quarter of the volatility. So markets at all-time high, the stock market, bond markets at a very low point. That's an opportunity if you're very heavy in the stock market, is maybe shift some of that, lock in some yields, and benefit from lowering rates that we know are coming now.
Interesting. Final point on the small companies. Why is that important?
Yeah. So large companies in the market, they can issue debt, they can issue stock. Smaller companies can't do that. Even, your small businesses, they're heavily reliant on borrowing in the open market.
Right.
So what this does is it lowers the rates, it gives an opportunity, and what that means is that less small companies will fail because interest rates are so high it was choking them. So that's an opportunity there as well, something to look at. But better news for small company,
and for the people who work
business
there,
owners,
maybe less likely to get laid off and that kind of thing if their companies are in better shape.
All the benefits to lowering rates.
Thank you, Doug. Well explained, as always, Doug Flynn.